Hello and welcome back to the latest episode of Shaken Not Burned, a cocktail of solutions for a sustainable future. My name's Felicia Jackson and I'm joined by my co-hosts Heather Dinwoody and Julia Bottaro. Heather, I think you've got a big story for us this week.
I do indeed, and I'm sure we've commented on this before. It's been in the running for a long time, but the EU's Corporate Sustainability Due Diligence Directive has finally come into force. That came in on Thursday last week, so I just thought it would be a good opportunity to have a bit of a chat and a reminder about it. So these rules have basically been put in place to keep companies accountable for both their environmental progress and also on some of the social issues we talk about and governance as well. Why not chuck that in? So the rules are going to apply to large European companies with over 1,000 employees and over 450 million euros in annual net turnover. And that's covering their entire global operations, not just what they make in the EU. It's also going to apply to another 900 or so non-European companies who also have over 450 million net turnover in the EU. And the rules involve quite a lot of different things, but it's basically to do with identifying, monitoring, and reporting on environmental and social issues, and that's risks and also opportunities as well. So I think it's safe to say that this will be difficult for companies and there will be expenses. They've got the costs of establishing and operating their due diligence processes. They've also got the transition costs of the expenditure and investments it will take to actually improve what they're doing based on the data they report. And there is also that sort of hanging threat of there's going to be administrative supervision of these, and that could include penalties and fine, and also even civil liability for any mess ups. But I also thought it was a good opportunity to kind of talk about the benefits to companies as well, because with these rules in force, they've now got a sort of harmonized legal framework in the EU that's going to create a bit of certainty and level the playing field, increase their appeal to customers and to employees, just to get that trust in that they are holding themselves accountable. They can get more awareness of their risks, because although we talk about companies as these big entities, there are people in those companies who actually want to do something, and that takes knowing the problem first. And they can also improve their risk management, build resilience, increase their competitiveness, more attractive to talent, more inspiration to innovate. There's all sorts of reasons that these could actually be really beneficial for companies while also benefiting people and planet and everything. So now that they're finally enforced, I suppose I just wanted to put to you two, these have been heralded as these groundbreaking new rules. How effective do we think they're going to be? Do we think companies are ready? What are your thoughts?
Certainly for me, I think most companies think they're not ready. And we've seen that with the introduction of a lot of different regulation. There's been a lot of pushback. I think what's particularly interesting about the CSDDD is that it actually tries to work through and explain what the chain of activities are, what the value chain is, what risk-based due diligence is. And even, it's important to be clear that things like civil liability, yes, civil liability is an issue under the CSDDD, but actually a company is only liable, say, for example, if one of their business partners or suppliers causes damage, but they're only liable if the company itself has intentionally or negligently fail to comply with their duties as set out in the directive. So what a lot of this is about is saying this is how you're supposed to behave. It's saying that as long as you do as you're supposed to, then you shouldn't have that much of a problem. And I think that's particularly interesting that there's been such pushback about these frameworks for reporting, because actually if you're acting like a responsible corporate entity, well, you shouldn't be liable for anything, because you should know what's going on. You should be able to talk about it. And I think in many ways, we're simply talking about a shift in the way people think about what's normal. We're expecting transparency. We expect companies to know what they're doing and the implications and the consequences of their choices. What's happening now is they're being asked to report on those. And tell us about them.
Yeah, I think that the issue about being ready is that many companies are not ready, and it is definitely a lot, as you said, Heather. There are costs involved. Need to set up teams or hire consultants or whatever. But I'm glad that the European Union is taking action and is just saying, okay, let's do better business and forcing the change on people, because we need that type of bold action from regulators.
I mean, I suppose, yes, playing devil's advocate, I can understand why pushback about liability shouldn't be a problem if you're a good company anyway, but there is the cost of setting up the processes and of doing the reporting. But I really think the benefits will outweigh those costs. I suppose I'm not running a big multi-million euro company, so it's interesting bringing it back to the EU level like that, Julia. I wonder, how do you two think that this will influence the UK, the US, Australia, just countries further afield? Because I know, that's been a big sort of point of divergence, is that the EU has typically been a lot more thorough in its reporting guidelines. How do we think this is going to affect legislation in other countries?
Well, I think that actually depends on what you think the legislation is meant to achieve. And what I mean by that is it's really interesting if you look at the CSRD and what's happening with the SEC in the US. In many ways, we talk about the potential expense of implementing the right kind of reporting. And if you look at the CSRD in Europe, it's gone a lot further in terms of the kinds of disclosures and the complexity of the disclosures that are demanded than the SEC does. According to the SEC, and these are rules that are under attack in the courts at the moment, so they've been delayed until the court cases have been resolved. But according to the proposed rules, there are Scope 1 emissions requirements for listed companies and Scope 2 emissions reporting requirements for larger companies. Scope 3 emissions are completely ignored. Scope 3 emissions from the value chain are not reportable. Now, the EU CSRD says Scope 1, 2 and 3 emissions for listed companies, are necessary. And to be blunt, it's Scope 3 emissions where the complexity and the cost comes in, because there's estimations, there's uncertainties, how are you supposed to report on material issues if there is uncertainty around those? But I would actually argue potentially that what you have at the EU level, while everyone's complaining about it now, is the potential to put businesses on a pathway to being more competitive. Could it be a competitive advantage to have an in-depth understanding of where your weaknesses are, of where your strengths are, of how closely you align and can reliably communicate about the benefits of the way in which you do business? We talk about recruitment and retention for staff. We talk about the changing values and norms of consumers. Yes, there is a greater requirement and the short-term cost may be higher, but long-term, I actually think that what EU is doing is setting companies on a pathway to have a better understanding of what they do and how they do business, and that could give them a competitive advantage. So on the question of the complexity of the supply chain, I actually want to talk about a new cement-free concrete, strange as that might sound. We know that the built environment is hugely problematic in terms of emissions, but cement alone accounts for 7 to 8% of global emissions. It's really hard to abate. It absolutely must be decarbonised if we're to reach net zero, given the amount of buildings being put up and the infrastructure we need to build to reach net zero and to help sort of build back economies beaten back by COVID and by inflation. We've got estimates suggesting demand for cement is going to rise 50% by 2050. That is a huge, huge problem for decarbonisation. Now, there's a company called Secret, which basically says that it's been able to create a sustainable alternative to Portland cement. Portland cement is effectively what, you put into concrete. And Secret says it's created this binder that replaces Portland cement. So every ton of Secret prevents about a ton of CO2 emissions. Now, it's done its first ever pour in a commercial building in Seattle, poured 60 tons. What's interesting to me about this is it's a redevelopment of a 120-year-old brick building using concrete as part of a retrofit. Because one of the things we know that comes up with construction is that it's one thing to address new construction, but about roughly 80% of buildings, at least in the global north, that are going to exist in 2050 already exist today. So we have to look not just at how we create alternatives to cement in new developments, but how we actually use them in adaptation, in reuse, in the reuse of buildings. So for me, I just got very excited about the idea that there's yet another cement alternative. There's lots and lots of different companies that are trying to create these alternatives. I just think this is a very exciting possibility. And if we actually are able to work on this, then we might actually have a pathway towards addressing net zero.
Yeah, I think it's really exciting. And, it's crazy how much cement we use because we're still building houses and infrastructure constantly. In some countries, there are entire pieces of infrastructure to build. In the UK, there aren't enough homes. And so there are more homes to be built. And we're just using all of this material that has an insane impact on the environment. But of course, we do need all of these new buildings. And we simply need to find ways to make it more sustainable. We can't just say, okay, we're not building anymore. So I think it is great that the industry is working on this. I'm just wondering what it will take for these technologies to scale up and be adopted at a wider scale and potentially by all construction companies.
Well, I think scale up is always the challenge for any new technology. I mean, I think one of the things we talked just there about recycling, I think there are new technologies coming up all the time. At Cambridge University, at the Materials Processing Institute, they've come up with a way of using used cement as a substitute for lime flux. That's used in steel recycling. So we could actually kind of replace lime with used cement and recycle. The thing is, you have to have the right policy frameworks in place to provide a good view for companies about what the stability of the market's going to be like. Is it going to grow? And we have to have the right incentives in place. We talk about renewables and, the enormous drop in price of solar and wind due to subsidies being in place. Yet at the same time, while we are seeing massive growth in the deployment of renewable energy is without doubt the lowest cost of energy generation in many places in the world, but it's still not getting as much investment because the profitability of such projects is lower than fossil fuels. There's still too much short-termism in the market. And because the market is set up to make decisions in business based on what's the most effective financial return I can generate in the next 3 months. There are companies who are looking at things in the longer term. There are technologies being explored and developed, but we need as a society, as a culture, as a market to look at things in a different way. So on that note, I think, Julia, you've got another story for us about how we can change the way we look at the things we normally do.
Yeah, I also have a story about an innovation that hopefully will reach the market soon. And it is definitely as exciting as cement, but it's something that people could taste by themselves when it comes out. So a French startup called Gourmet has applied for regulatory approval for its cultivated foie gras in the European Union. It has also applied in Singapore, the US, UK, and Switzerland, but it is the very first company doing so in the EU. And the EU is considered, at least the company says, a gold standard for food safety. So it's basically a big deal. And also when the European Food Safety Agency approves or not, you never know, but in case it approves it, then it will be sold in all the 27 countries. So again, that's quite a lot. So the company is expecting the process to last for 18 months. So if the foie gras does hit the market, it will be in 2026 and it will be for chefs and restaurants. So we won't be able to buy it at the supermarket, but we will be able to eat it when we go out. And I think this is really crucial that we've got more and more cultivated meat potentially hitting the market. It currently is approved in 4 countries, in Singapore, Israel, the UK, and the US. And there are a lot of other companies that are developing this type of products, and they've mostly looked at Singapore. So yeah, I think I personally cannot wait. I think it's really exciting because meat has a major impact on the environment. And I think foie gras is one of the ones that are particularly bad because I don't know if people are aware, but it is made by force feeding ducks and geese so that their livers grow abnormally large. So it just sounds horrible. And in fact, in many countries, production has been banned, but it is being sold still. And in fact, even at the Olympics, which are deemed one of the most sustainable Olympics ever, is still being served. So, clearly foie gras is regarded as a delicacy, but it's great that someone has found a new way to produce it. And, this is about the animal welfare, let alone the environmental impact of breeding all the geese and duck, all the resources that they consume.
Sorry, for our listeners, should we maybe just give a brief reminder of what cultivated meat is?
Yes, of course. Yes.
As opposed to other meat alternatives.
So cultivated meat is when a cell of the animal is taken and put in a lab to grow. So it's being given cultured food. The cell is being fed in the lab, and then the meat magically grows. I mean, yeah, the cells replicate and create the final product. And then this is...
So it does have the exact same taste and texture as regularly farmed meat, basically.
Yes, exactly. And it is considered more a product that would entice people that eat meat as opposed to people who are already vegetarian and vegan. And this is compared to what we find in the shops, which is plant-based, which is maybe looks like a sausage, but inside has got ingredients that are entirely plant-based.
What's really interesting to me about this is it's the potential for co-benefits, which sounds like a very cold term. But to me, it means if we're able to provide an alternative form of food that tastes and feels the way the original did, without using those resources, but also without causing pain to another living being or taking advantage, that seems to me to be an incredibly positive action to take on multiple levels.
So I definitely agree with you there. I would say I think cultivated meat can very much differ in the growth hormones that are fed to the cells. A lot of them do still use animal cells that are not obtained in a very nice way. So the animal welfare argument might still be a little bit out. Although having said that, I have written previously about some biotech firms that are coming out with, animal-free ways of doing this. I mean, so I know I'm speaking as the one on the panel here who doesn't eat meat, but of all the things, foie gras? I've never eaten it in my life, but
it's a French speciality.
it just, ooh.
I think it's the idea of starting with premium food, perhaps. It's probably good to start with one of those that are most horrifying in the way they treat animals and then move on to the rest. And I do think that starting with a premium food that you can only serve at restaurants could create this sort of interest and then move on to the mass products. I do think it could be a good strategy. I mean, ultimately, I think we should get to every meat being cultivated. I personally can't wait to see prosciutto and mortadella made like with cultivated meat.
I mean, I definitely appreciate it's a good thing that they're doing. I suppose to me, just foie gras never stood out as something I particularly wanted to eat in the first place, but that is just me. One thing I did just want to clarify, I know, Julia, you're kind of our expert on this subject matter. There have been a couple of other companies that have applied for approval in the EU, aren't there? I don't know if it's just in specific countries or...
There was Aleph Farms, which is an Israeli startup that applied in Switzerland and the UK. So it is in Europe, but it's not the EU. But yeah, lots of cultivated meat happening. So again, anyone doing prosciutto mortadella, please hit me up.
But it's, I think that's part of the quest. That's part of this issue, that it's not for people who have given up meat. It's for people who want to give up meat because it's a healthy and planet positive thing to do, but don't want to stop eating the things they like.
Absolutely. It's different target markets, and only by catering to all of them can you get them to shift in unison. So hopefully that's what we're going to see.
And I think that's a very positive note on which to end today's discussion. So I'll say thank you to my co-hosts, and we'll be back in a couple of minutes with our interview of the week. Hello and welcome back to the latest episode of Shaken Not Burned. Today we're lucky enough to be joined by Nikki Harrison, who's responsible for sustainable finance at the Environmental Defence Fund. Now, what I would love if you could explain, Nikki, because we read about it all the time, it's all talked about, we know it's being discussed at the moment in government, we know we need this green transition, but what is sustainable finance? And what does EDF do with regard to sustainable finance?
Sure. Well, Felicia, first of all, thank you. Delighted to be here. So look, sustainable finance is really about the power that private finance has to act as a catalyst to help accelerate the transition. That's certainly how I see it. So finance can go towards dirty things that don't help us with the transition, like fossil fuels, but finance can also flow towards clean technologies that can then help accelerate the transition. And, I would argue that there isn't really another sector that goes across the whole economy in this way that therefore has that sort of whole economy power to really influence the transition.
Does that really mean that what we're saying is that if we get sustainable finance right, we get the transition right?
So yes, I would say, but I would also say that sustainable finance can't do it alone and doesn't occupy, doesn't operate in a vacuum. Sustainable finance also needs government policies to be in the right place so that then those financial flows can go towards the right places. So, yes, but also there's more to it than just that.
But within a framework that lets it happen.
Exactly.
Excellent. So what does EDF do?
So EDF works on sustainable finance because of this power that we think that the finance community has to accelerate the decarbonisation of the economy. Really, we look at sustainable finance through two lenses. One is this piece around within specific sectors, how can finance accelerate the decarbonisation of those sectors? So whether that is the energy sector, the agriculture sector, the transport sector. And then we also look at then across the whole financial sector, what are the levers that go across the whole financial system that then have the power to accelerate or conversely impede the flow of finance towards decarbonisation activities?
And so one of the things that I think is quite challenging for a lot of people is we hear the term sustainable finance and we hear climate finance, and you talk about the importance of getting the right levers. But is that investment in early stage companies? Is it investment in public equity? Is it investment in infrastructure? Is it insurance? What should we actually be looking at?
I mean, the answer is everything, right? And I think this is why there's a whole kind of systemic change that is needed. We need every part of the financial system playing its role to accelerate financial flows towards decarbonisation. Each of those actors have different roles to play. So, venture capital, case in point, can really do that kind of early stage startup investing. The banks can, take some of that early stage investing and then start to transition that into more mature companies and a more kind of mature profile. Insurance, I think insurance is a really interesting one. Now, it has got a real role to play in helping with the resilience within different sectors. And so, actually some of my colleagues work on the insurance side, and one of the things that they're looking at the moment is around building codes and how can insurers make sure that when there is a disaster, that insurance funds are given to really build back to a much higher standard that will then invest in those resilience or those sort of resilience.
No, there's an example I've got here, which I heard about, which is an insurance company that when building is flooded, part of their insurance payment pays for the development of sort of water soaking up plants and landscaping. Is that the sort of thing you're talking about?
Exactly that sort of thing. So yeah, exactly that. So you can build back to a higher standard that will mean that then if, a flooding event or whatever happens again, then those homes are less likely to be affected because they've got that resilience baked in to the sort of rebuild. And so that's something that colleagues of mine are working on at the moment.
So it's actually about more than just making sure finance goes to the transition, but it's about making sure we have a long-term response to the challenges.
Exactly.
This to me is fascinating because what does it mean for business if finance becomes more sustainable? What does it mean for the financial sector?
So what it will mean ultimately, if it's successful, is that the cost of capital will be lower for those more sustainable businesses, and it will be easier for those more sustainable businesses to attract finance.
Now, you see, that's a really, really interesting area for me because there's been a lot of conversation recently about profitability. And obviously, cost of capital affects profitability. One of the challenges the renewable energy sector supposedly has is there is no question that renewable energy is cheaper than oil and gas, but the profitability is lower. So if we have a lower cost of capital for renewable energy companies, would that mean that they have a higher profitability? Possibly,
yeah. It's a super complex area.
So what does the growth of sustainable finance mean for industry and ordinary businesses who are looking to take part in the overall sort of nature positive net zero transition? Often actually, because you see a lot of leadership in the large multinationals, but I'm thinking about all the smaller companies that make up 90% of every economy. What does that mean to them?
What that means is that all of those companies need to be thinking about what does their transition to a net zero nature positive economy look like, because ultimately, if banks and other investors are trying to align their financial flows towards net zero and nature positive, then those companies that aren't aligned with that transition will find it harder to attract financing. And, this is where I think the role of transition plans is incredibly important. So the UK has actually been at the forefront of really producing guidance around transition plans. And what we're seeing now is that financial services firms are really looking at their clients' transition plans, really looking to assess, hold their clients to account on how well they are firstly at this stage producing those transition plans, but in time they will start to look at then how are their clients actually meeting the commitments that they set out in their transition plans.
So how does the concept of sustainable finance relate to ESG? Because, you mentioned this idea of putting plans together and talking about what we're going to do, which is reporting. One of the things we obviously hear a lot about is ESG and the backlash in the US. How does ESG, which is a risk-adjusted investment lens, relate to sustainability and strategy and long-term change?
Yeah, I think, look, there are lots of different labels here that are doing slightly different things, right? So you could look at ESG through the lens of reporting, for example. But I think what I'm saying here with the transition plans is that actually the important thing here is how does it go to your strategy? And your transition plan should be, what is that strategy for moving towards a net zero and nature positive future? And that should be set by the board, and it should permeate through the organization, and it should go to how will your business model evolve where it needs to. And that's the bit that I think that the financial institutions will be particularly holding firms to account on. Now there's also the ESG side of things, there's the kind of reporting side of things, there's metrics that you get from MCSI and and other ESG institutions. But I think really it's the strategy piece that is the most important piece.
Now, this is fascinating to me because obviously, in the press, in the media, most of what we see is about ESG. But I think that brings me back to something you raised earlier about systemic challenges and the need for systemic change. I mean, I know that you were involved with the Bank of England's work on climate change and climate risk. What are the levers within the system that we can actually use? Because when we talk about sustainable finance, we can talk about cost of capital, we can talk about how much capital should be held against climate risk. What sort of levers do you think are going to be most effective?
So I think the number one thing for me is about having net zero transition plan for the whole economy that is then supported by sectoral pathways in those kind of key high emitting sectors. And then underneath that, investment plans that support delivering those sectoral pathways. Because once you've got that whole economy and then sector by sector plan, that really allows the financial sector to then come in and play its part of accelerating financial flows to the right places. So that for me is kind of the number one. I also then think that there are other things that can be done sort of within the financial sector. This comes more to the role of the Bank of England that can then help drive change. Now, climate change as a risk is a very different type of risk from the usual risks that central banks are used to dealing with, like credit risk, operational risk, and the like. We, at the central bank, we typically thought of risks over the course of a business cycle, right? And that those risks would be cyclical, they would go up and down. Climate change is very different to that. Climate change is a cascading risk. It's increasing over time. But crucially, the sort of long-term outcomes for that risk are dependent on actions that we take now. And therefore, it requires a very different way of thinking about risk management and thinking about how you go about risk management. And I think that's something where the central bank, as the regulator, can really help change how companies are considering climate risk within their portfolios, which should then in turn affect pricing and affect the cost of capital.
That's a fascinating way of looking at things, partly, I think, because I'm used to enterprise risk management. What companies do is they have a duty to look at what risks are coming up and explore them. But I don't think many companies have really got into a place where they are really genuinely integrating an understanding of climate risk into their operational planning. How much difference do you think that will make? How long do you think it will take before companies start doing that as a matter of course?
I mean, I think they are going to need pressure from the regulators in order to do it as a matter of course. I think we've seen some really good examples actually in the EU with the European Central Bank. It has done a whole kind of supervisory program around how climate and environmental risks are being embedded within banks' risk management practices and is then kind of calling out privately behind closed doors, but calling out to those institutions how well or badly they're doing and what they need to change. I think we're starting to see that in the UK as well with Supervisory Statement 319 that the Bank of England published a few years ago. But I would say that there's still more to be done to really get the risk management properly integrated into pricing models and properly quantified as well. At the moment, that isn't there in the way that I would argue that it should be.
So that's something we definitely need to look at institutions and the regulators and researchers to take what we know about climate science and translate that into quantifiable risks that can be priced and therefore change the allocation of capital.
Exactly.
And that's what you're doing at the Environmental Defence Fund.
That's what we're trying to do indeed, yes.
That's absolutely wonderful and an incredibly worthwhile thing and a very exciting time to be working on it, given obviously we can't pretend we haven't just had the election and the government has changed and there seems to be a very different perspective on what needs to be done about the climate risk and the nature risk. Feel free not to answer, but I'm just wondering what would be your big asks for the new government? We've already got the Great British Energy Company and we've got the National Wealth Fund. Do you think that's enough? What else do you want to see?
So look, I think both of those are very important steps in the right direction. And actually this very question is something we've been collaborating on with other UK NGOs and have actually written to the Labour Party on sort of in private at the moment, but it's something we will be making public. What we'd like to see is Labour setting out an ambitious plan for investing in green growth. So that should include a net zero investment plan. We'd like to see Labour leveraging the power of the financial sector to drive that plan. So one way of doing that could be giving all regulators an explicit statutory objective on climate change, nature and biodiversity that would help then kind of deliver the mindset shift that we think is needed for this kind of new paradigm. And then the final thing is focusing our public institutions on delivering green growth and prosperity.
That's brilliant. I look forward to seeing what their response is. And now my final question is always, what haven't I asked you that I should have done?
I mean, I think for me, the thing I would call out is the scale of the funding gap that is needed to get us to a net zero aligned economy. And that has been estimated in the UK alone to be 50 to 60 billion a year. And clearly the public sector cannot put that in on its own, which is why the role of the private sector is so important in my opinion. And so that is why we really need to work out how we catalyse the private sector and give the private sector that sort of level of certainty in the direction of travel. And I think that's something that sort of past year or so of the Conservative government, the direction of travel on net zero has not been, quite as aligned to that, net zero future as you might have hoped. And that has therefore made it harder to have that investment certainty. And I think therefore Labour taking action to restore that investment certainty is really important.
I think that's a wonderful and very positive note on which to end. And I certainly hope that the new government pays attention. Nikki, thank you again so much for joining us this afternoon. It's been really interesting finding out your thoughts on the future of sustainable finance in the UK. For our listeners, thank you for joining us. And of course, you can subscribe and like us wherever you get your podcasts.